Hello and welcome to this video. If you're trying to understand accounts, or you're training to be an accountant, or if you're trying to understand how your accounts work and you're trying to figure it out from start to finish, or maybe even you're trying to figure out what QuickBooks Online or other bookkeeping solutions are doing with transactions, then this video is for you, because what we're going to talk about today is the fundamental basics of a concept called debits and credits. Hello, my name is Aaron Patrick. I am a chartered accountant, a certified UK trainer with a fancy new logo, that QuickBooks Chap on the internet, and also head of accounts here at Boffix. And at Boffix, we want to make sure that you understand the concepts of accounting, not just throw a set of accounts at you and hope for the best. So when it comes to the concepts of accounting, nothing is more fundamental than the term debits and credits. I have in front of me here how the first known recorded use of the term was in 1494, and actually the concept of debits and credits hasn't changed ever since that first recording. So it's got to be something that is worthwhile understanding if it's been around for that long, and that's what this video is all about. Not only do we want to understand the concept of it, but we want to understand why it's important, what makes debits and credits so important, and why you should worry about it. Okay, let's go straight into this then, and let's first understand, and I'm going to use my iPad to try and explain this as much as possible, but let's first understand why we're even worrying about it. Okay, so using my iPad, in front of me I have a set of accounts. Now the accounts have a lot of words in here, and you can scroll through past all the words until you get to the numbers, and it's the numbers we're interested in this video, because the numbers are obviously the most important aspect of a set of accounts, and the concept of how these numbers are put into this particular way is down to debits and credits. You see these numbers here, and we can pick any number we like. So there, turnover 922,378. The reason that particular number is in there is because it's made up of debits and credits, which go on what's called a trial balance. So to us to get confidence in that number, we need to understand how that number has been created, why that number appears on this piece of paper in front of us, why that number is 922,378. Well, the reason it is because of debits and credits. You see, a set of accounts is made up of a financial statement called a trial balance. And all a trial balance is a collection of debits and credits. See why debits and credits are so important? Because without debits and credits, we couldn't get to this number. So bear with me here. At the moment, I have an income statement with 922,378. Remember that number. If I jump into the trial balance that represents this particular set of accounts, then you'll see here that my sales figure at the top there is a credit, we'll understand what that means later, of 922,378, that exact number. Now in front of me now is what we would call a trial balance, and it's a trial balance that basically is the fundamental backbone of what a set of accounts is. You see, every number on here that we scroll down here will at some point appear within the accounts. Now they'll either appear in what's called a profit and loss account, so if I just go back to that set of accounts, and the profit and loss account is basically going to be any income that you've generated in the year, less any expenses, which gives you a profit. And obviously a profit is really important to us because that's how much tax we pay, that's how much money we've made. It's going to be a fundamental part of what we do for business. So how did we get to those numbers? Again, we used a trial balance, and again, a trial balance is made up of debits and credits. Hopefully you can see why debits and credits are so important. So our trial balance is made up of two elements. Everything in this particular trial balance, above the 3,000 number here, so where it says UK corporation tax, everything above that line is what we call our profit and loss account, our income statement, and everything below that will create our balance sheet or statement of financial position. Now one of the key concepts of a trial balance, if I go to the very bottom here, are these two numbers. This is our total for this particular trial balance, and in this trial balance there's lots of different transactions going here. There are thousands of different numbers that are interacting with this trial balance. But the key concept is this at the very bottom, this total. You see, this total, adding everything that's gone on in this particular set of accounts, means that we have an equal amount of debits and an equal amount of credits. So the first main concept here is that the phrase debits and credits, you must have an equal amount of each one. You can't create a set of accounts without making sure that every time you put a debit in place, there's a corresponding credit, and they have to equal. just like this set of trial balances here. Okay, so we've kind of got into the understanding that to understand a set of accounts, we need to understand what a trial balance is. And to understand what a trial balance is, we need to understand what debits and credits are. But what are debits and credits in the simplest term? Now, the best way for me to explain that is to think about it in terms of a bank account. You see, a bank account is probably the easiest way for us to understand and explain the concept of what a debit and a credit is. If you think about it, if you're moving money from one bank account to another, now this could be you're moving from your main bank account to a savings account, or it could be that you're giving money to someone else. Then think about what happens in both those scenarios. You see, if I was going to move £100, then for me, first of all, in my main bank account, my bank balance would reduce by £100. And then in the other bank account, it will increase by £100. And all I'm doing when I'm moving money around is I'm basically moving and reducing a balance in one account and bringing up an account in another. And you don't just have to do it for bank accounts. Think if you were moving cash around and I had a piggy bank and I was trying to save up for a car or for something else, then if I wanted to move money out of, say, my main source of income, so my main cash account, and it was my wallet, for example, then I would be reducing the amount of money in my wallet and increasing the money in my piggy bank. And every time we move money around, that's what we're doing. And if you think about it in that concept that we are moving money from one account to another, either bank or other, then you can understand and start to understand how debits and credits come about. And when we're talking about them in an accounting sense, then we're talking about what we would term as T accounts. So instead of using the naming function for piggy banks, bank accounts, or anything like that, we're going to use the term T accounts as what we're going to call each and every one of those little accounts when we're accounting for our financial statements. And if we look back down at the trial balance, all of these lines here, so I've got the first one, sales, the next one, opening stock, the next one, purchases, each one of them is what we would call a T account. And if I want to look even further down, I would go from my trial balance to my nominal ledger, find the right date range, generate it, and now I can see that trial balance again, and you can see that if I added all these up, I would be able to see it will come back to exactly the same figure. There's my same number, 922378, but this time I can press the little plus button, and it's going to show me all of the different items that are making up that. And this is what we would class as a T account. And in this case, it's not a T account for my bank account, it's a T account for my sales account. So my sales figure represent all of these numbers here. So let's recap what we've learned so far. From our financial statements, our set of accounts, we have a load of numbers on there. Those numbers are presented to us via what we call a trial balance. Our trial balance can be broken down into nominal ledger, which shows us all our T accounts and all the transactions that relate to that T account. And how do we interact with T accounts? Yep, you guessed it, debits and credits. So for every debit that we have, we need to have a credit. And that means every transaction that we have within the world of accounting, within the world of business, everything that we do is going to be related to now in debits and credits. And as accountants or people studying accountants or people who understand the concepts of debits and credits, it's a little bit of a superpower for us all. Have you ever been at a gig or a concert and you've seen your favourite person on stage and they're just playing their music and they're reading their music sheets and it looks absolutely effortless? And you sit there and you wonder, how are they understanding that other language and trying to figure out what's going on? Or maybe a coder or someone who can speak multiple languages. We've always seen those people and we've always been impressed of how they've been able to take something that looks alien to us and be able to translate it and understand it and actually create some art form out of it. Well, in a crazy way, that's exactly what accountancy is in terms of debits and credits. Once you've figured out the concept, you're going to be able to see day-to-day transactions, i.e. you buying something or you selling something, and you're going to be able to figure out how that concept will be able to relate to debits and credits, because it's basically another language. It's a way of being able to interpretate day-to-day transactions, but put them into debits and credits so that we can then show them in a set of financial statements. Okay, so we're starting to understand the fundamental and the importance of what debits and credits are, but we've yet to really figure out how we're trying to bring that into play. And what I want to do now is I want to show you some examples of debits and credits with one little trick that I find was the way in which I was able to understand them much easier. You see, one thing you'll find with debits and credits is initially they look daunting, and they are. They're a concept. They're, like we said before, that's a whole new language we're trying to understand. But I promise you, debits and credits are one of those things that at some point will just click, and when they click, you'll start to understand them a lot more. You'll start figuring out what's going on. So if I use my iPad again, and I look at these concepts here of having a look at these T accounts, and what I'm going to do here is we're going to mark this up with an opportunity for us to understand exactly what's going on. Now, for me, the most important thing for us to understand when it comes to debits and credits is to relate it back to a bank account. Because as I said before, T accounts, debits, credits, all that sort of stuff, all can be easily related to different accounts. That concept of moving from £100 from one bank account to another, well, that's what we're going to show here. Imagine here I had bank 1 and bank 2. Well, I need to do debits and credits. That means I've got to go to debit one of these accounts and credit the other. Well, always think about what's happening. So if I'm transferring £100 from bank 1 and I'm transferring it to bank 2, how does that relate in debits and credits? Well, at the moment, I need to show that I've had £100 credited over here and I've had £100 debited over there. And think about what that means. That means that bank 1 is now going to reduce the amount of money that's in there by £100 because a credit is reducing the amount that's in there. And if you think of a bank statement, you'll see that you'll have payments in, payments out, and they're always split into those columns. Well, the reason they're split is because it's fundamentally part of debits and credits. And if I was going to transfer money out, I'd expect it to be on that right hand side. I'd expect my balance to be reduced by 100, which is exactly what's happening here. And then on the other side, I'd expect £100 to increase my balance, which would go there. So straight away, if you go back to the fundamentals of doing a bank account, you can start understanding, start visualizing, because I would expect to see, if I was now going to go and tick my bank account up, reconcile my bank, I'd want to go and see here, I'd expect £100 to be shown on the right hand side of my bank as a payment. And then I would want to see on the other bank account £100 received in. And straight away, we know now that if I was going to do a trial balance and add all these transactions together, then I would have £100 as a debit, £100 as a credit, and my trial balance will balance. Let's make this a little bit more complicated. You see, now that we understand that debits and credits, we have to have, every time we have a debit, we have to have a credit. Let's start trying to relate normal transactions. So this next transaction, really straightforward, we're going to be understanding that we've received £100, but this time it's not come from a different bank account to another. We've received it because we've sold something. We've made a sale. So what T accounts will we need? Well, we're going to need to have our bank again, aren't we? Our bank's always going to be important. And we're going to need a T account called sales. And what sales going to represent? How much we've sold in a particular period. So, first of all, always go back to that bank. Do we want the money to go up or down in our bank? Well, we need it to go up, so we're going to have £100 debited there. That's the easy bit. Debits and credits always have to have a plus and a minus. They always have to balance. So if I've got £100 debit, I'm going to have £100 credit. So with that logic, I'm going to have to show £100 as sales. Now, fundamentally, this now makes sense because we now have £100 debits and £100 credit. So we are be able to put our thumbs up to say that we have now got debits and credits that are matching. Again, if I was doing a trial balance, it would now balance. But what does this mean? Let's have a look and understand it. Well, first of all, from a bank point of view, our bank balance has gone up £100 and we expect that. That's what we want to see. We've now got an extra £100 in our bank that we can spend on whatever we want to spend it on. And on the credit side, we're showing the credit of £100. And what that means is that our sales are now showing £100 more. You see, if you go back to those financial statements we looked at, sales were credit, expenses were debit. So here in my example, I know my bank account's right, so I've got a tick against that one. So that means my sales must be right. I don't need to understand why at this point a credit means that I've incurred more sales. I just need to know and understand the concept that my bank must be right, therefore my credit's right. And if I always use that concept that my bank and do my bank first, I'm always going to be in the right place. So now let's look at option number 2. Let's say we've bought something this time. Let's say we've bought some purchases. And guess what? I'm going to use my bank account again. This time we bought some purchases for £50. Well, first of all, what do I want to happen in my bank account? I want my money to go down. So I've got £50 in my credit. If I've got £50 in credit, I now need to have £50 debit. Debit and credit wise, they now match. And what that means now is that I've got £50 left in my bank. So I'm happy with that one. But I'm showing a debit, I'm showing a cost for my business, £50 there. And again, we've used the bank account first to get our head round if I'm right, if I'm wrong. I'm showing £100 going up when I put this sales example in. I've showed £50 going down when I put my expense in. And if I think about it from a concept of if I was doing a set of financial accounts, well, I would add these two together. This will create a fact that I now have £50 left in my bank. On my set of accounts, I would have £50 on my balance sheet. And then on my profit and loss account, I would show £100 of sales, just here. I would show £50 worth of purchases. And if I take £100 less £50, that means I've made £50 worth of profit, which is exactly the same of how much money I have in my bank account. So again, working back to just the banking principle means that we can actually start understanding debits and credits. And it doesn't matter how complicated we make our transaction. If we relate to our bank account, we're always going to be in a position where we're going to understand it. Okay, so that's putting it down in real simple terms. And if this is something that has been useful to you, then do drop us a comment and a like below, because this could be something that we go and look at much more complex scenarios, and again, relating to the bank. Because I promise you, every transaction that you can think of at some point needs to hit that bank account. So it might not be that the first transaction you're thinking of is going to have to hit the bank, for example, trade debtors, trade creditors, but at some point they will. And if you always use that concept that at some point it's going to hit my bank account, then you'll start to understand what if it needs to be a debit or a credit. Now, if you're looking at this from a concept of using QuickBooks or Xero or something like that, then head over to my other channel, Aaron Patrick, the QuickBooks Chap, where I'm going to do a follow-on video looking at debits and credits. And we're going to look at what debits and credit means for your bookkeeping solutions, because what they do brilliantly is hide the fact that it's debits and credits and make it so it's really user-friendly. At the end of the day, understanding the debits and credits is going to help you massively understand what's going on. And there we have it, debits and credits. The one rule is try and put it back to the bank account. If you can make your debits and credits relate to your bank account, and you know if that bank account needs to go up, which will be a debit on the bank, or down, which will be a credit on the bank, then that's going to give you an opportunity to be able to understand what's going on. Again, drop a comment below if you want us to go in more complex details. If you want us to show you maybe the concept of how VAT gets put into place, how it works for debits and credits, how journals work, them sort of things, then we can go on a whole series there as well. My name's been Aaron Patrick. Hopefully you now understand debits and credits. If not, remember to relate it back to your bank account and you will be absolutely gravy. It's been a pleasure to do this video for you, and I will see you in the next video. Bye for now.